Cool. All right. Well, after that little mishap of technical, just a little technical thing going on there. Welcome to you. I'm back from Mars now. Back now here. Sam Evans with you. Thanks for being here. It's 31st of August 2015. Good to have you here. This is Sam Evans of Online Trading Academy. Hope you're well and happy. We're doing a little session here for 40 minutes or so on technical analysis versus supply and demand. As you know, I've done a number of these webinars before, and if you haven't managed to catch one of those before, I'm going to be explaining today the core concept behind our patented core strategy. So I'm going to use this as a little review. Just got about 10 slides or so I want to go through. And going through these slides, I just want to kind of, anybody who's new in the room, anybody who's new, who's, not been in here before, who's not maybe heard Sam Seiden or myself kind of do one of these webinars, then I'm going to be going through the concepts that we teach at Online Trading Academy with you in the time that we have, and going to combine it with obviously some slides and then looking at some charts as well. If you've got any email questions for me after, you can see in blue on my slide here, sevans@tradingacademy.com. You can follow me on Twitter at SamEvansTrader as well. There's all my details on there. Guys, I'm going to get straight into the meat of this because of time being what it is. What I want to do is, and let's not get me wrong here, I don't use really classic technical analysis as such in my own trading. If you've ever seen any of my webinars, you'll know this. Same with my colleague Sam Seiden, my mentor as well, who he is. And what I'd like to make very clear here is we have a wealth of knowledge coming through fxstreet.com. This is just obviously coming from where we are, Online Trading Academy. I want to show you a little bit of a slice of the way we teach and the concepts that we go through. And, we meet a lot of traders, a lot of people who've been doing this a while, looking to increase their edge in the marketplace. And I think one of the things that I know is a very, very important thing is to really think about, obviously, the strategy that you're using. Now, beyond any strategy, let's make it clear. A lot of good, well thought out strategies can work, guys. A lot of them can. However, we've got to have good, solid risk management skills at first. Okay, that's going to be our foremost thing, a trading plan, and then rules. But beyond all of that, we want to be trading in a style that allows us to keep our risk very low and our reward very high, and also allows us to be able to, maximize the potential of a trade. And this is where, starting to look at technical analysis through the traditional means, we have a few problems. If you take a look at the 4 shots that you're seeing in here right now, I've just picked out, and these are available on pretty much any website or any book about technical analysis, 4 basic chart patterns: the head and shoulders, the cup and handle, the double top, and the double bottom. Nothing unique about these, nothing groundbreaking. However, it always interests me when I look at these shots, how they instruct people to use these particular tools. Where you see my black circle is here on the head and shoulders, or my black ellipse on the cup and handle here. Taking a look at this, most of these chart patterns are taken, and the people who use them are encouraged to sell where our black line is here, or buy where sell where our black circle is here, or buy where our black circle is here. And I've asked the question on here, what's wrong with these strategies? Well, one of the major problems that we have with these strategies is they mean that any trader or investor trading in today's markets would be selling here after an already a drop in price, assuming that the price is going to carry on going. It would have somebody buying this breakout of the cup and handle neckline after the market's already been trending up for a period of time. Likewise, we can see a break of this traditional trend line here on the double bottom signals for many people an opportunity to buy here. And the issue is that can work. As you can see, the price broke out and continued here. It worked out just fine. It worked here and here. So I'm not saying that these patterns don't work, but what I'm inviting us to consider here is they do get us to the game very, very late. And what it means is when we come to the market late, it means that we reduce our risk, our reward, we reduce our reward. We also increase our potential risk, and we are at a higher potential of being whipped out. When you jump into those markets that have already moved, you take the trade and then you're trying to follow the trend that's already in place, and then the market kind of snaps back, takes you out, and then goes off without you. A very frustrating thing that I meet a lot of people with a similar conundrum in the market. So my question for us to hear is, why would we want to sell after a drop in price when we could maybe be selling at these highs here? Well, why do we want to buy here when we could be buying at this particular point or this point? Does that make sense, guys? See, what we do at our school is we're trying to get you to think like a professional and try and sell near these areas. Now, we're not going to just randomly pick highs and pick lows to sell at. But what we have to understand is a lot of these chart patterns, these are all reversal patterns, the double top and the double top and the head and shoulders. The double bottom is a reversal. The cup handle is a continuation. But as Ray's just saying here in the chat box, the problem with this is it gets us into the market very late, and we don't want that. And it's the same with many other strategies as well. A lot of conventional thinking that we come across with books of technical analysis overcomplicate things. And one of the things I've found with trading very, very clearly over the years that I've been doing this is the simpler I keep trading, the better it tends to work out. You guys found that? The more and more information you've got to look at, the tougher it becomes because you start to get conflicting signals. And, I say, if you look at this screenshot here, we've got a number of different technical indicators that we could be using on here. And again, I want to stress this. I'm not saying that technical indicators don't have their place. They are good analysis tools. They can be used very effectively to help your trading decisions. The one thing you've got to understand is pretty much every single one of these things that you see on here is a lagging indicator. And what I mean by lagging indicator is if you take the Bollinger Bands on here, the pivot points, the RSI, the commodity channel index, the MACD, the moving averages, all of these things on this chart here only print on the screen when the price actually moves. If you take them off, the price will trade just fine without them. You understand? So it's not like a chicken and egg syndrome that we have here. It's about saying to ourselves, okay, we have secondary lagging indicators. Why don't I use a primary leading indicator? And a primary leading indicator in our school, in our way of thinking, is recognizing what supply and demand look like on a price chart. Because the thing I've always wondered about, and I've had the privilege of being trained by people who didn't read about this stuff, that actually worked in Wall Street, people who've run hedge funds. I was trained by people who worked on the floor of the biggest exchanges in the world. They were my mentors. They didn't have access to use any of this. They were using price and price alone. And what that meant for them was the real way that they would make money, the profitable way that they would be making money was be looking to buy after a drop in price, okay, when the price level hit an area of what we call demand, and sell after a rally in price to a level of supply, okay, where they'll be looking to take profits. It involves not being involved here in the middle. It means we are buying as low as we possibly can and selling as high as we possibly can. And it can be a nerve-wracking thing when we first look at charts and we want to take all of these tools off. But when we start to look at what a picture of supply and a picture of demand looks like on a price chart, it means that we can get in early when our risk is low and our reward is maximized. And, this is the way we make money buying and selling anything. It's the way we make money doing anything in life. We buy at wholesale, we sell at retail. And if you struggle with the concept of supply and demand, think about it like a wholesale and a retail perspective. How a company buys something and puts it on the shelves. Okay, they buy it wholesale, they mark it up on their shelves and sell it for a retail price. Okay, and this is exactly how we can make money in the markets. If you guys, who's been watching the huge sell-offs in the market last week? And you guys watch that? Some of the fantastic price action we saw in the NASDAQ and the S&P and the Dow last week? Yeah? Do you see some of that? Yeah? And what happened? On Monday, we sold off so hard. The Dow was down 1,000 points and the market's retraced 50% of that move already. Okay? Because there are a lot of institutions and people seeing an opportunity to buy low. Think about all the people who sold into those areas, and we'll take a look at this on a price chart. After a strong drop, sure, it can continue, but if the signals are on your charts to tell you that there may be a good opportunity to buy with a very low risk, this is actually the highest probability trade that we can take, and we don't need to be right very often. This is the great thing I want to say about this. We don't have to be right very often, because if we buy low and we sell high in the key areas, then we're going to have maximize our risk to reward ratio as well. And this is how you do business with anything, okay, guys? You can go into a store and buy things off. Well, you could, but think about having a business where you went into a supermarket and bought products from there and then set up and took them home to your own store and tried to sell them for a higher price. No one would buy them for you because they can get them cheaper elsewhere. It's not a viable way of making money. So we have to buy as low as we can, sell as high as we can. It doesn't matter what we're trading, guys. What time do we use for supply and demand trading? What a great question. Well, it depends. If you're talking about the charts, it depends on your style of trading. We can look at larger time frames for for long-term wealth trades, position trades and swing trades, daily charts, weekly charts. Okay, we can go down as small as 30-second, 1 minute, 5 minute, 15-minute, 1 hour charts for short-term income trades as well. The picture of supply and demand is always going to show itself on the price chart. Okay, if we know what we're looking for. Okay. Now, this slide here is, something that I always get all of my students who I teach in the classrooms and in my online programs thinking about. There's buying and selling going on in everything: gold, oil, Facebook, lean hogs, currencies, the euro, the yen, the pound, anything. And all the buying and selling is taking place in the markets. And the market participants are made up of retail traders and investors who typically struggle to make this work, okay? And banks and financial institutions who are very profitable at doing this, okay? And the question we've got to ask ourselves, guys, is when we look at this is, do we really think that most retail traders and investors are doing the same thing as the banks and the institutions? Well, of course not. It's at the end of the day, what we've got to look at and say, well, the reason why these major institutions are profitable is because maybe they're doing things a little bit differently. Maybe they're treating this like a business. And I'm going to give a piece of advice to everybody without lecturing here or anything like that. But if you are going to put your hard-earned capital in the market and put things at stake in the market, treat it like a business, ladies and gentlemen. Treat it like a business. And the reason why I'm saying that is because, sure, you can enjoy it and it can be a hobby to some degree. I agree with that. But guys, the more serious we take this, the more respect that we give it, the more likely we are to have success in this. Because, I don't want this to be an expensive hobby, because I've been there and I've done that. And trust me, it's not a lot of fun. So what we're doing here is we're going to treat this like a business, because, at the end of the day, whatever you want to see about Goldman Sachs or any of these other guys, they are a business and they treat their business, take their business very seriously. What I want to say to you is, don't get put off by this. If you've never seen, these figures before and, never really thought about how retail traders and investors lose. Well, look, just don't do what they do. What we're going to do is let's not make the mistakes that most of these people make, and let's model the success of the banks and the financial institutions and go to the market with the attitude that they have. Yeah? Because, guys, with all of the different tools that are out there, and we go back a slide and just take a look at these, all these Fibonacci's, support and resistance, stochastics, all this information here, don't we think that maybe a lot of the banks and institutions know that most people are reading that stuff? Of course they do, yeah? And at the end of the day, they probably know where most people are going to be looking to buy and sell. So, you know what? We're like butterflies. These guys are like elephants. We can't take the elephants on, but we can join the elephants. And we've got to start to understand, what do the elephants do? Well, now let me ask you a question, guys. Let me ask you all a question here. Do you think that the banks and the finance institutions and the hedge funds trade bigger position size than retail traders and investors? Do we think they trade with much bigger position size? It's a pretty easy question, right? Of course they do. Huge, right? Much bigger. So that thing alone means something important to us, guys, that so many people overlook. Okay? The fact that they trade with bigger size means they have to trade differently. Yeah? Think about a question here. If I had an order to buy 1,000 shares of Microsoft at $40 a share, okay, and then as an institution had 250,000 shares that they were looking to buy at $40 a share, who's going to have more chance of getting all their orders filled, do you think? Do you think somebody trying to buy 1,000 shares at a specific price is going to have an easier time than someone trying to buy 250,000 shares? Who's going to have the easier time? The person with smaller size, right? Because every buyer needs a seller and every seller needs a buyer. And I think that's something that we all forget about. Every buyer needs a seller. I can have all the money in the world, but if someone's not going to sell to me, I'm not going to get my orders filled. And these orders represent supply and demand in the marketplace. Does this make sense? Yeah? You see, an institution is a business, and that business is going to do everything it can. And talking about risk management, what DZ's saying here, an institution and any successful business is going to try and buy as much as it possibly can at the cheapest possible price, and it's going to try and sell as much as it possibly can at the highest possible price. Now, is it likely If they've got a huge stack of buy orders down at $10 here, do you think all those orders are going to get filled? Well, probably not, right? Because they need enough sellers to sell to them. Likewise, they're probably never going to sell all of their inventory at $80 because they need enough willing buyers. But what they're going to do is try and get as many as they can. And these stacks of orders where these high intensity piles of inventory requirements to buy and sell are stacked are going to create turns in price for us, guys. You know, it's always easy to get in the middle because there's no competition in the middle, right? The whole reason a low is created is because demand is greater than supply. The whole reason a high is created is because supply is greater than demand. It's these unfilled orders here that are truly moving the price. And if we flip this on its head and take a look at it from this perspective here, okay, then we think about it just like a candlestick chart, okay? Now, my question to you is this. If we take a look at this chart right now, and I want you to think about this movement that was coming down here right now, as the price was coming down on this area here, what do you think at this point here where I'm circled, what do you think every technical indicator was already, like all the moving averages were doing at this particular point? All the moving averages were probably pointing down at this particular point, right? We're making a series of lower highs, lower lows, lower highs, lower lows. And so, you know, if you look at the trend following signals, you're probably going to be thinking about waiting for a pullback to continue to get to the short side of things. Every moving average will be pushing you down. Now, you may have been getting a nice oversold signal as well somewhere down here as well. But again, the issue is, where was that thing going to turn? Well, let's look at the chart for a second and let's see what that says. I want you to look to this area of demand to the left-hand side. There's a couple of things we can know about this demand zone, okay? Okay, it's this stack here of unfilled orders that's right in our zone here that originally created this move to the upside. You see this move to the upside here? That just tells us something. The fact that the price moved so far away from this demand zone tells me there was a big stack of buy orders here. And why I know there's a big stack of buy orders there is because the price rose from here. Because let me ask you a question, guys. If at this point where my box is right now, if there was an equal stack of sell orders like this at the top of my screen, and I've got my buy orders here, if there was an equal stack of sell orders and an equal stack of buy orders right here where my X is, would the price have moved up like that, do we think? If there was an equal set of stack of buy orders and an equal stack of sell orders at this point where the X is, there would have been no movement, right? There would have been no movement because there would have been equilibrium. If you've got 100 people willing to buy at $20 and 100 people willing to sell at $20, price won't move. So clearly somebody with much deeper pockets than me had a big old stack of buy orders right in this area where it says demand, which created a move in price. And again, guys, let's ask ourselves a question. Who can trade that kind of size? Only institutions. Okay? Only the institutions can trade that kind of size. So again, I know that this demand level was an area where there were a ton more buy orders than there were sell orders. And did all those orders get filled? Of course they didn't. Did all the orders to buy in this area get filled? Absolutely not, because if they had, price would have stayed in the area. And secondly, as well, I know it was institutions that made this move to the upside. And you know why it was likely institutions? Because retail traders don't have deep enough pockets to create that kind of move. So it's no real surprise that when the prices return to our area at this particular point in time, we look back to this area here. The chart was telling us one thing and one thing alone. This is a low-risk buying opportunity. A low-risk buying opportunity, an opportunity for us to get long. To sell to the people who are focused on the downward trend. To sell to the people who are focused on, hey, the trend is down, I want to short rallies. Well, how do you think the person who sold down at this area here is feeling right now as the market rallied from this particular point? See, the technical analysis is only telling us what's already happened. We've got to look at the charts and we've got to say, okay, based on what the chart is telling me, what is likely to happen next? Okay? Now, those institutions we're talking about, by the way. I think we forget who these guys are. Major banks, major insurance companies, major investment organizations. These are the guys, and we can't beat these people, but we can trade like them. They throw a lot of money around in the market. And guys, also I want to stress this to you. Don't think that they don't get it wrong too. They do get it wrong. Every institution is going to get things wrong at some point. This is the way the business is. We all can get it wrong. But these guys, as I see somebody typed in here, risk management is their number one priority. And, going back a slide on here, if you've got the bulk of your orders down at an area where prices are cheap, you can afford to invest more because there's less risk on buying something cheap than there is on buying something expensive because it can't go down as much. Okay? So these are very basic business concepts that we're teaching at the school, that I teach in my classes. Okay, that apply to the real world markets. And again, it's, we've just discussed this. Who moves these markets? Do you think the retail traders or the financials? Well, what we've got to do is model. We've got to model what the successful institutions are doing and trade the way that those guys trade. Okay? Now look at this. There's a lot of traps in the market here, okay? And then we're going to go and take a look at this on the charts as well, okay? Here we have moving averages. I'm sure some of you guys are familiar with it. And again, let me stress to you, I'm not here to pour scorn on every technical indicator, okay? I have a mentor who doesn't trade this particular way and still does very well out of it, very well out of it. But he's got his own rules that work for him. He's got an appetite for risk that wouldn't necessarily be in line with most people's appetites for risk, okay? So again, it's about making sure, and that one, you're keeping this safe, and two, you're giving yourself a chance to make it work. Because the thing to understand, guys, is the lower your risk is and the higher reward is, the longer you can stay in this game, and the more chance you have of overall success in the long run. Now, again, thinking about a classic use of a moving average here. The blue moving average here is a 20-period moving average. Most textbooks will tell you, very simply, to use a moving average as a trend indicator. Well, as you can see here, we should focus on buying when prices are above the moving average and focus on selling when prices are below. Well, this period here, we're below the moving average. You see that? Market falls down into an area right here, point B, and we're below the moving average. But what have we got to the left? We've got our pattern, our strong rally, with our little bit of basing here, telling me that institutions were trying to buy at point A here, and they didn't get all their orders filled, did they? So the chart is telling me one thing. Price is telling me this is a low-risk opportunity to buy. I don't want to sell after a drop in price into a level where demand has proven to be greater than supply. Of course, prices could go lower. Prices could go lower from this particular point, but that's what I'm going to have a stop loss in just below here in case. Notice how then the moving average is completely disregarded and the price resumes its upward momentum. Likewise, again, we do enter a downward trending mode at this particular point, and then we start trading below the mighty 200-period moving average. But again, at point B, of course, it's fine to go with that trend, but only drive your car while you've got green lights. You stop at a red light. Well, we've got a red light to the left here. Look at the pattern that we've got here again. Look where institutions stepped in here. Look at the strong takeoff in price that we see. Did the institutions get all their orders filled here when they were trying to buy? Of course not. There's no way they got them filled, because look at the way the price took off. In fact, their buy orders completely evaporated any willing sellers in that area. There were no more willing hard sellers up until much higher in the chart, signaling this as a very low risk point in which to buy. Prices return to this area at point B, and even though we're below both moving averages, we are in a downward trend. The price then resumes an upward move from this particular point here again. A complete confliction. Now, of course, following a trend is always going to be a smart thing to do, and don't get me wrong, we do that too. We do that too. However, we've got to know where a trend is likely to end, and the trend is likely to end at a key area of demand or a key area of supply. What we're doing here is timing the market. We're looking to identify the moves before they happen with a high degree of accuracy. Now, All it is just about separating away from any traditional methods that we've maybe encouraged to buy and sell with, and look at this from a logical point of view. So if we take a look at this, let's apply some institutional thinking to his price chart here on the left, and then we'll go over to some of the charts and see what they're telling us as well, okay? We've had a strong drop in price right now, okay? Now, if you told somebody without any understanding of how money's really made in the market that this is a great time to buy, okay, they would probably say to you, you're nuts, okay? When all the orders will be filled is when the level breaks. When the orders are all filled, the level is broken, okay? That's when it's done. And then it's about looking for where the new imbalance is going to be. So we never know if an area is going to fill. And let's talk about that right now. At this point here to the left, I know that there were more willing buy orders than sell orders. How do I know that? Because of the way prices took off. If there were equal buyers and sellers from this yellow box here, we would not have had this rally in price, would we? No way. Okay, we would have had sideways action. Okay, so when prices return back to this area here, I've got to look and say to myself, well, institutions were trying to buy a lot here. Now, do I know why? Somebody answer that for me. Do I know why institutions were trying to buy at this particular area? Do you think I know why? Or do you think that's guesswork? Anyone? Anybody think they know why they were buying there? Okay, anyone? Because it's cheap, right? Previous support, maybe. We can come to conclusions, can't we? We can come to conclusions, but we don't really know, do we? Guess what? You could look in the newspaper. Isn't it funny when you see every day when the market closes, you get a long list of reasons on the websites why the market went up or why the market went down, right? You always get reasons, don't you, why people were buying and why people were selling. But that doesn't help us. Why does that not help us? Because it's already moved. It's after the fact. We've got to say, okay, I'm never really going to know why, but I do know where. I don't know why they were buying here, but I know that this is where they were buying. As Ray's saying, who knows, who cares, right? The fact is they were buying here. And when price comes to this area here, okay, I'm going to look for the pattern of demand on here, even though most people say, well, it's crazy, that's bad news, it's too risky, because here my risk is low. Now, sure, more sellers could come in here, absorb the rest of those buy orders and push the market lower. What am I going to have below here then? I'm going to have a stop loss. Okay? I'm going to have my stop loss just below this area here. Okay? Be prepared to take a small loss on it. But I know that people were buying in bulk here last time, so guess what? I'm going to take a shot myself. Now, if I apply this to real life thinking, and say I was in the business of trying to buy myself a brand new smart TV right now, and I went in the store prepared to pay the retail price for it, and that day they had 50% off the TV, would I hesitate to buy then? Or do you think maybe I'd say, heck, I'll snap that thing up before it sells out, right? I might even buy a few of them and see if I can resell them on eBay or Craigslist or something, right? That's exactly what anybody would do in a store when they see a bargain. Well, is it really any different on a price chart? Yeah, we buy here, prices rally from our area, okay? Exactly, okay? Buy them cheap, okay? It's what we do. The risk on a $10 share is $10. The risk on a $50 share is $50. Think about that alone. So we don't just simply buy because it's a red candle. We don't just simply sell because of a green candle. We look for the pattern. And what we like to teach in a lot of detail is our odds enhancers and some of the key things, but I'll go over some of the basics with you here. This is what our classes do. What we do at our academies, what I teach my students do, is how to start to pinpoint these. But I'm going through this, a level to give you an understanding, to give you a feel for it, okay? The simple fact that prices took off from this area is enough for me to think, well, there's a good shot that markets would buy from that and move from that particular area as well. Understand? Now, this is what our patented core strategy is, guys. What I'm showing you here. Our patented core strategy is it's been covered in many different areas as well. And we apply it to stocks, futures, options, Forex as well. All different asset classes too as well. So this isn't something, that you find it this way that I like to teach, Sam Seiden likes to teach. It's something very unique to us at the school. It's something that I find a lot more easier in my trading. It's helped me immensely to start to recognize the market for what it really is, guys. And it comes from just understanding those charts, which we're going to go over to. Because, guys, I just want you to look at this, and we'll go over to the charts now. Think about all these different things on here. There's so much information out there. Look at this. So much information out there that we could pay attention to when we buy and sell, right? Earnings, news, income statements, recommendations, economic reports, announcements from the Fed. I'll never forget when I first got into trading Forex, everybody was like, oh, you know, it's fair because you'll get the news at the same time. Yeah, but guess what? Let's hope that I interpret the news the same way as everybody else interprets the news, because there's no guarantee that that's going to happen, right? See, all this information that's out there, all it's going to do is create certain thoughts, certain perceptions. And those thoughts and perceptions, yeah, are going to make people buy, right? Yeah, I know, right? Do the opposite to what they tell you to do, Eugene, and usually you'll have a good time. All the different thoughts, all the different perceptions, all the different information that's out there, okay? All that different information that's out there. That's sure it's going to create people's decisions to buy or sell. But we don't know these. We don't know why, okay? But what we do know is where. Absolutely rumors, right? I tell you, the great thing about the market when you learn it is it's nothing to do with the actual markets. It's just to do with literally people looking to buy low, people looking to sell high. And it's about understanding that it's a rule-based approach that we have to have. Don't focus on being right, focus on being consistent, and focus on being a risk manager. Because you know what? All these reasons why people buy and sell are true, but we do not have the capabilities as human beings to know why everybody's buying at the same time or selling at the same time. So we just need to go, where are the footprints? Where are the supply levels? Where are the demand levels? Because people may not tell you why they're buying or selling, but if you look at the chart for long enough, you can start to see where they were buying and selling. That makes sense? Let's go over to a chart. Take a look at see where things are right now. Okay? Now you've seen this a lot. I mean, especially in the euro as of late. We know we've had some great areas here on the euro and so on. This was an area that I was looking at recently where we overshot a little bit on this area here, but there's been some other good opportunities since. But again, you know, one thing I'd say to you guys, if you're watching the markets last week, we had a ton of volatility in the markets. And I was looking at this supply area here where a lot of institutional selling was taking place. Prices came into, so we're overshot by a few ticks. We managed to break down after. So I'll be going to be keeping a close eye on this 1600 area. And let me explain this to you for a second here as well, guys. I mean, anyone who's a regular in the room knows I look at the euro dollar with you quite a bit. But you know, guys, you know, looking at these markets and looking at what they are, you know, I think there's never been a time more to really get into when you're trading currencies, really start to see those charts and where those institutions are buying and selling, you know, these areas of supply and these areas of demand. And, you know, there's some really nice looking areas that I'm focused on right now on here as well. And, you know, one in particular that I'm really kind of looking at over the next coming days is this zone here. Now, I'm just going to mark this on and just show you there. This is a great looking area that I like. I don't mind it, you know. I found it a little choppy. I found it a little choppy last week because of the news, but there's been some really nice areas that we had around here. You know, I think, you know, choppiness is going to hurt you if you're not patient. You got to be patient, though, you know. You got to be real patient with these markets. And, you know, there's some very clean levels like this supply area from 1400 broke down beautifully to this previous demand level at the 8108s. This is a level I was looking at right here that missed by just a very small amount and we took off from. But my best advice is, yes, it has been choppy, but if you can be patient and wait for the areas that are the lowest risk and the highest reward, then we got something that we can work with. Now, this area here that I've got between 110.80 and 1021 is only a 60 pip area. Just think about what happened here in this particular zone. Look at the rally that we had from here, this strong rally that took place from 110 all the way up to just 117. We had a 700 pip rally on the euro from this particular area. What does that tell us? Yeah? What does that tell us? What I tell us that who had buy orders here? Who were there more buy orders or sell orders down at this area the last time that we were there? Okay, you know when all the orders are filled and you get stopped out. That's when you know. Okay, that's when you get when you take a loss. That's the best time to know. Okay, yeah, good strong demand. Were there more buyers and sellers here? Absolutely. Look how prices rallied from this particular area. Okay. Now, those institutions didn't get all their orders filled here. I don't know why suddenly the market, we could use fundamentals as the reason why the market, people were buying at this demand zone, why institutions stepped in at this area. But again, do I have a written letter from Goldman Sachs saying, well, Sam, this is why we were buying at this particular price? I don't have a written letter and a statement coming out of Morgan Stanley or anyone else. But what I do have is a footstep. A big old footstep on the price chart right here, and it's a footstep that tells me between 110.80 and 110.20. This area here is an area where I would take a very low risk buying opportunity on the euro dollar. Very low risk buying opportunity on the euro dollar. Likewise, this area here where we had another very strong rally on here. If the market came down to this 108.40 to 108.10 area, I've got a very low risk buying opportunity with a nice type stop. Okay, and what we could do as well is take these down to smaller time frames if we wanted to kind of get involved in this on a small. Like I like these daily areas. What we could do as well, though, if we wanted to, we could go to a smaller time frame, maybe something like, I don't know, let's take a look at a 4-hour chart. That's kind of a popular one as well. Let me just sort my charts out. They're doing this horrible outlining right now that I don't like. And by the way, you know, since this market broke down, we've had some real nice supply areas that have given us opportunity to get involved in this market. We had a nice demand zone hit earlier on today, literally just touched into this area and rallied, you know. But yeah, we could go after this small time frame. We could wait for some demand right in the middle here. We could go to it on a 60-minute chart, which is okay. I'm not a big fan of going down onto too small a time frame to do that, though. One of my reasons for that is just because I don't like to miss out on the trade and get too cheap on my entry. So for me, you know, looking at that daily chart, one of the things I love about the Forex market is that we can really be quite adaptable with our position sizing. So, you know, what you could do is just try and have an entry a little bit lower on here around the 110.50s. Okay, and I'll be looking for a final target back up at this 1.5 area, but I will be obviously using some trade management in that because I don't want to kind of give back any profits should I actually get a nice profitable trade off that area as well. We can see some other nice key areas here. See, this is a wider area back here that got triggered in April, but you see the price did go a little bit deeper into the zone and we got got a great move off here. This previous area here gave us a good area. So again, you know, guys, you know, I find if we get too tight on our entries, sometimes we do run the risk of missing a trade. So again, you know, I find I can see those nice institutional areas on those daily charts pretty well. That helps me immensely. Let's go and see what's going on the cable as well. See, I mean, we've just come into an area right now. We're holding in. We came again to see with the volatility that we've had. We had another key area where we sold off from on the pound. And again, we're in a zone right now, which to me, it's okay. It's okay, this area. It was good for a couple of day trades, but for a longer term trade on here, I want to really kind of get the very, very best price. And I love this area down here. You know, I always like to try and get it as cheap as I possibly can. And this area down here, between the 150 and 150.85. The price has not been back to that area for quite some time. And what I like about this is the fact that the price haven't been here. We had a great move away from there. Okay. This market from this area didn't really achieve anywhere near as much as it did back here. So there's some serious institutional buying that took place in this previous area here. So, you know, I always like to get a little bit lower, a little bit cheaper on here. And there, obviously the pound right now has had a reaction to this area and it's moved away. The fact we're coming back into it means that some of those orders are getting chewed through right now. And like I say, you know, though, if we do go for the more extreme areas and think and trade like an institution, we don't really need to be right anywhere near as much. In fact, we can, once we get into a position, and here's another thing, the reason why I like to get into these daily areas is once I'm in it with a date on a daily chart, I can always add to the position and build more. So I'm watching this area closely right now. I believe that we could probably, if we don't break this area, if we don't break 153, just let's call it one, if we can hold 153s, I would expect us to probably rally to around the 155s. There's probably about a 200 pip rally we could get in there, but a clean break of 153 would create some major supply in the 154, and we probably at least test the 150, 150s and a little bit lower from that particular point. So that's one of the key areas that I'm looking on right now. Another one that's been quite interesting is the dollar against the Canadian dollar right now. You can see actually today we actually retraced back into a beautiful daily area and have sold off pretty nicely. We've seen some good rallies in oil, which could help this. Personally, I'm seeing a market here that's really dying for a sell-off, really is. But to me, the area that I'm definitely kind of the most attracted to right now is this whole price area here around the 127s. Prices have not been back to this area, and this is a wider area, of course, 127.42 to 127.62. So you could definitely want to go to some smaller time frames to see on that. But there was some serious institutional buying that took place in that particular area there. So, that's going to be a long-term target for me on this dollar Canadian, because that's where I saw the bank stepping in at that last top point. And if we can hold these current highs on here, I would expect further prices pushing to the downside, considering especially how overbought we are and the strength of oil that we're seeing in the current markets as well. So I hope, guys, that was something just gives you a little idea. Always with these webinars, we don't have a ton of time on all of these sessions on here as well, but it gives you a little bit of an idea of what we do at the Academy. I highly suggest if you see any other webinars on here with Sam Seiden, my colleague, on here as well, you hear him speaking very similar language to me. It gives you a little bit of an idea of what we do at the school as well. And I hope that was a good little refresher for some of the guys who've been in the room. So gives you a bit of an idea for how we like to look at the markets as Online Trading Academy. And another place you can go to is go to tradingacademy.com. I'll quickly show you this. If you want to, you can go to tradingacademy.com. And if you're interested as well, getting some more information on the way we look at these institutional areas, if you go to tradingacademy.com, guys, and another great thing is you go to the resources. This is our website here, and go to where it says lessons from the pros. You'll see on here as well articles that articles that come out every Tuesday. They're free articles that you can subscribe to on here. Sam Seiden writes them. I write them. My colleague Rick Wright writes them. So this is our latest Forex article you'll see on here as well, with a lot of the lessons and key things on here as well. Another way to stay in touch with what we're doing. So I hope they help you as well. FX Street, thanks for having me, guys. Thanks, guys, for joining as well. I'll see you next month, and have a great trading week, and try and stay safe in these more volatile market conditions. Be well, everybody, and thanks a lot. Take care. Thank you very much. Goodbye.